My name's Sam. I'm a financial advisor here at AdviseWise. I'm joined by Dr. Steve from our investment committee, and today we're here to talk to you about our quarterly market update. Steve, it's been a volatile year, but we seem to be having a little bit of a rally, particularly over the last 3 months. Can you tell us a bit about what's happening, I suppose, to start with in the Australian market?
Yeah, sure, Sam. And it might surprise people that, in fact, it's quite a positive last quarter. You know, in the media, it always seems to be things are bad. But you can see here that the Australian market, yes, been volatile over the year, but in the last quarter, we're up by 9.4%. That's a pretty strong quarter. And the US too is up by 7.4% in that quarter. Now, it has come off just in the last few weeks. That was when the Federal Reserve in the US made it clear that there are going to be more rate rises this year. But you can see overall, Australia's done pretty well. It's down by minus 1.1% for the year, and given the year that we've had, that's pretty good. When you look at the US, that's down by minus 18%.
As you've alluded to the US and the performance over the last year, what sort of contributed to that over the past quarter and 12 months, Steve?
Yeah, well, look, a great part of the US market, about 35%, is in the high-tech stocks, or the NASDAQ stocks. And you can see in the chart here, Sam, that the NASDAQ is down by over 33%. Other markets aren't as bad as that. You can see Europe's down by 10%. China, that's down by 20%.
And with everything that's gone on over the past quarter and 12 months, how's that played for an Australian investor in some other developing and emerging markets?
Yes, and well, in the developed markets, the US is the biggest part of the developed markets. It's about 65%. So again, you can see the rally in the quarter there, both the developed markets and the emerging markets up about 4% for an Australian investor, but the developed markets are down due to the US, and the emerging markets are down as well, and that's because of China. They're a big part of the emerging markets.
For fixed interest, Steve, perhaps a little bit of an anomaly style year with what's happened particularly over the last 12 months. Can you tell us a bit about why that is and what sort of has occurred over the last sort of 3 months?
Yeah, so you're right about an anomaly. Our bond markets are normally pretty stable and normally give positive returns. So this is the worst return for a bond market probably on record, with inflation that's come at the end of 2021 on the end of COVID. Then the only way that central banks have to fight inflation is through interest rates, and obviously, as everyone knows, interest rates have been rising dramatically over the year, and when interest rates go up, yields of bonds go up. When yields go up, prices go down.
So we know it's been perhaps a bad year for bonds. Is there any good news on the horizon?
Well, actually, Sam, that there is a little bit. When you look at this chart, it's showing quarter by quarter the returns of the Australian bond market, and overlaid on the top there, you've got the yields. As we've talked about, when yields go up, those prices go down. So the first 3 quarters have been really badly negative. But you'll note, Sam, just in that last quarter, in our December quarter, it's actually a positive return for bonds. It's a small positive number, which is, a small comfort to people who have been investing in bonds. But it does also indicate that we might be coming to the end of this interest rate cycle, and the bond market sort of pricing in the fact that, yeah, we know there's a few more interest rate rises to come, but that terminal rate is not very far away. And I think, Sam, it's important for people who have worn the pain in bonds, particularly if you're in a more conservative portfolio. You're probably wondering, how did this happen? But bonds are now earning 4 or 5% in income, just if yields don't do anything else. And Sam, there's lots to talk about there about the economy slowing down, and most people are expecting rates to start coming back off either at the end of 2023 or in 2024, so then the bonds will have a capital appreciation as well.
Thanks for that, Steve. I think it's a little bit of a reminder this past 12 months that volatility does exist in a long-term style of investing, and it is part of the course and nothing unusual, perhaps never wonderful to go through, but it is part of the course, and we emphasise maintaining a well-diversified portfolio that is cost-conscious, and to engage with your financial advisor whenever you have any concerns. That's it for today. Thanks for watching, and see you next time.